Coming up on today's show, how to protect yourself and your retirement from the tsunami of higher tax rates ahead. David McKnight, best-selling author with his new book, Tax-Free Income for Life, joins us right after this. Hi there, everybody. I'm Ron DeLegge with ETFguide TV. Great to have you along for the ride. Now, before we go any further, be sure to watch our other weekly episodes like ETF Battles, along with the Portfolio Report Card, and don't forget to subscribe. Americans everywhere face a looming retirement crisis. We've talked about it multiple times on this channel. The threat of higher taxes into retirement. And David McKnight has written about this. He's studied it, and he's author of many best-selling books. His latest one is called Tax-Free Income for Life. It's available at Amazon.com. I encourage all of you to get a copy. Dave, great to see you again. This is part 2 of our original conversation, so great to have you back.
Thanks, Ron. An honor to be on your show as usual.
You spend a lot of time in this book talking about longevity risk, and I want to bring our audience up to speed. Some people would say, well, living too long deep into retirement, well, that's a wonderful problem to have. How do you see it?
Well, the reality is most people don't have an infinite supply of money, right? And the longer you live, the greater the likelihood you're going to run out of money before you die. So as much as I beat the drum on the risk of rising taxes over time and how that's a threat to your IRAs and 401ks, when retirees get surveyed over and over and over again, they say that their number one fear is running out of money before they run out of life. So simply put, longevity risk is the risk of running out of money before you die.
So what are some ways that people can mitigate against longevity risk?
Well, one of the common ways, I'm not going to say it's the most effective way, but historically, one of the most common ways is to simply try to accumulate a huge pile of money before you retire by day one of retirement, and then sort of limit yourself to drawing a very small percentage of that money. And the studies show us that if you can limit yourself to a very small distribution over time, then you run a high likelihood of not running out of money before you die. And historically, that percentage that you're supposed to take out is 4%. They've called that the 4% rule. It was pioneered by a guy named William Bengen in the early 90s. And basically what he did is he ran a couple 100,000 Monte Carlo scenarios and said, hey, look, given a 50-50 stock bond mix and given 4% distributions over a 30-year retirement, what's the likelihood that you're going to run out of money before you run out of life? And it was, only about a 14% likelihood. So people had a lot of confidence in this 4% rule. The problem was he was using, bond rates that in the early 90s were a lot higher than they are today. The stock outlook in the early 90s was a lot rosier than the one we have today. And so a lot of experts have downgraded the rule, the 4% rule, to the 3% rule. And that's tough because that means if you need $100,000 above and beyond what Social Security provides for you in retirement, divide 3 into $100,000. That means you will need to have accumulated $3.33 million by day one of retirement. Not a lot of Americans are going to be able to pull that off. So that's the first way that you can try to eliminate longevity risk. The second way is by using a very verboten term in our industry, and that's an annuity. And it's essentially offloading that longevity risk to companies that can manage it much better than we can personally. And these are life insurance companies. And essentially what they do is they pool your money with the dollars of lots of other Americans. You give them a chunk of your liquid savings, you hand it over to an insurance company, they pool it with the savings of lots of other investors, and they basically say, hey, look, we guarantee that in exchange for that lump sum of money, we will give you a stream of income that will last as long as you do. And mathematically and scientifically, all of the studies show that has the ability to really extend the life of all of your retirement dollars. And so those are the two really the most common ways of mitigating longevity risk. Or I guess there's a third way, and that's just dying much sooner than you anticipated dying. So,
yeah, that's the least preferred method.
Preferred method, right?
Yeah, I don't mind dying. I just don't want to be there when it happens.
That's right.
Tax rate risk is another thing that you discuss in the book. And for people with the mathematically incorrect balance or what I call the wrong or incorrect MIB. That's the bad MIB. You always talk about the good MIB, the mathematically ideal balance. But those that have the bad MIB inside their taxable and tax deferred accounts, they need to reposition that money into their tax-free bucket. And Roth IRA conversions can certainly help with that. So what's the optimal scenario? Do you pay taxes on Roth IRA conversions out of your tax deferred bucket or from somewhere else?
You know, the basic premise behind the Roth conversion is that you believe that tax rates today are lower than they will be sometime down the road when you're planning on taking this money out. So it's a simple arbitrage. It's a question of arbitrage. Do you think the tax that you would be required today on that conversion is going to be lower than the one that you would be forced to pay 5, 10, 15 years from now when you're planning, when you're planning on taking this money out? So there's another key sort of criteria or consideration is, do you have the ability to pay the taxes from an account other than the IRA that you happen to be converting? Because that is the most effective way mathematically to execute a conversion. If you have money in your taxable bucket in the form of a mutual fund or a money market, savings account, checking account, really mathematically speaking, you're much better off paying the tax on that Roth conversion out of that taxable investment versus simply having the IRS withhold tax from the conversion itself. You want to get as much money into your tax-free bucket as possible. And the best way to do that is to pay for the tax on the conversion from a bucket other than the one you're converting.
People who are phased out of Roth IRA contributions because they earn too much can use something called the LRIP. So what are some key benefits of LRIP in the context of retirement planning? Tell us more about that.
Yeah, so the LRIP is a bucket of money that gets treated a little bit different than most of the other traditional buckets. And what happens with this bucket is you put money in. As your money grows, your bucket begins to fill. Only the IRS says that this bucket gets treated differently for tax purposes than a lot of the other traditional buckets that we invest in. So for example, they're going to tell you that as your money grows, you don't pay tax. When you take money out, you don't pay tax. They can guarantee that you won't lose money. And they're going to give you a death benefit. Okay. So the cost of admission to this bucket is that there's going to be a spigot attached to the side of that bucket through which flows the cost of life insurance. So in other words, you're going to get a death benefit that gets thrown in here. And what they're going to tell you is that should you end up needing long-term care somewhere down the road, they're going to give you your death benefit while you're alive for the purpose of paying for long-term care, which a lot of people like because it's not the traditional long-term care approach where it's use it or lose it. You pay for long-term care for 30 years, die peaceful in your sleep, never having needed it. And that money goes to pay for someone else's benefit. So the LIRP is becoming the go-to solution for meeting long-term care needs and building tax-free wealth while you're alive.
Yeah, and the other thing too about that is you got to qualify too, right? So if it's insurance, you have to be healthy enough to get it in order for it to make sense.
That's exactly right. Because there's that life insurance component. Insurance companies don't want to make sure they want to make sure you're not going to die in the next 10 years, because if you die in the next 10 years, it's a great investment for you, but it's a horrible investment for them. So they send you through an underwriting process to make sure that you're going to live long enough so that it's a good deal for them and a good deal for you.
Now, one last thing, Dave, before you take off, for some of our audience members may want to know about the timing of Social Security. This is something that comes up quite often. So when is it best to start? Is there any tips that you can share with us in that regard?
Well, this is a really easy question to answer, so long as you can tell me how long you're going to live, right? And if you can tell me how long you're going to live, that's going to inform that discussion. And I always tell people there's no better way to figure out how long you're going to live than by going through the underwriting process for the LIRP, because these underwriters are in the business of predicting how long you're going to live, and they can look at all of your information and basically pinpoint it. So the longer you're going to live, the longer you should put off taking Social Security.
Yeah, good points. And also too, take a look at your family history. I mean, not exact and precise, but certainly could be a good indicator of how long you're going to live in terms of longevity. And then the other thing I want to mention that I think is crucial to this discussion, as it relates to LRIP, is you really emphasize a multi-pronged approach to tax-free income. Talk about that.
Yeah, I get really uneasy when people go around talking about the LRIP or the LIRP as the end-all be-all solution. Really, the LIRP is only really effective when used in concert with all of the other tax-free vehicles that the IRS makes available to us. These are our Roth IRAs, our Roth 401ks, our Roth conversions. You can even take out of your IRA and have it be offset by your standard deduction and have a tax-free stream of income out of your IRA. And if you can keep your provisional income low enough, then your Social Security can be tax-free as well. So the LIRP is one of 5 or 6 different streams of tax-free income that you should be using to get as close to the 0% tax bracket in retirement as possible.
Solid advice, and congratulations on the new book. Keep up the good work.
Thanks for having me, Ron.
Again, you just heard from David McKnight, best-selling author, with his new book, Tax-Free Income for Life. It's available at Amazon.com. I highly recommend it. I'm Ron DeLegge with ETF Guide TV. Join us again for our next episode. Thanks for watching.